Welcome to the Investing with IndexHeads podcast, where we bring you your regular dose of alpha and beta and all things market. I am Anish Teli from QED Capital. It is truly a fanboy moment for all of us to have Sanjiv Shah, the father of indexing in India, and our inspiration to start IndexHeads on today's podcast. Sanjiv co-founded Benchmark Asset Management in 2001, and before that he was with DSP. Benchmark's mission was to launch only passively managed funds and specifically ETFs. They wanted to stay away from paying high commissions to agents, keep fund costs low, and pass on the benefits to investors. Benchmark launched India's first ETF, Nifty Bees as we know it, in December 2001. Benchmark was ultimately acquired by Goldman Sachs in 2011 and is now part of Nippon AMC. Sanjiv is currently a fintech entrepreneur, but he doesn't rule out returning back to markets if the right opportunity presents itself. And without further ado, let's move on to the podcast.
The opinions expressed in this podcast do not necessarily reflect the opinions of QED Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of QED Capital.
So, hi Sanjiv, good afternoon, and
Hi.
welcome to the Investing with IndexHeads podcast. So we actually wanted you to be the first guest, but then we thought, we probably want to build this up a little bit more and then come to you. So I know we've been talking offline and about this idea for a while now, but it's great to have you on, and it'll be great to start off with. Actually your story, and I know before Benchmark you worked with DSP for a while, right?
Correct.
And how did you stumble upon indexing, and how did you sort of in 2000 when indexing was okay, it was about 25 years in the US, like I think 76 is when Jack Bogle started the first index fund.
Right.
But it was still not where it is today. So in 2000 or 99, how did you stumble upon, or what was your epiphany or aha moment for indexing?
Sure. No, first, thanks for the invite, and I'm very happy that we actually have a indexing podcast in India now. It's very satisfying to me and my colleagues, who I'm sure will think that at least somewhere coming to podcast means you've arrived. Indexing has arrived, if nothing else.
Yeah.
And now coming back to what your question was, when we started off in 99, 2000, I used to be in DSP, and then one of the last things I did in DSP was actually, set up the whole derivatives business. And that's when I did, basically I was with, looking at all the derivative products which were being run by the international guys doing keynotes and things like that. And one of the things I saw that basically, what was happening was people were not betting on one company, but they were sometimes, betting on the industry as such. That's when, I got me interested in terms of, basically, why is that, basically people are thinking that, basically rather than buying just one stock, let's buy the industry itself. And that got me thinking that, and we, being in the market for 13, 14 years by then, that, it's very difficult to, basically anticipate which stock is going to do well. I mean, whatever people might say, you have to be a genius to, keep doing it. So, and then, this gave us an insight in terms of, look here, it makes sense for people to buy not one stock, but in the whole stock. And then obviously you got to understand indexing, what is indexing and things like that. And if you remember, around that time, NSE was trying to basically come up with the futures index on Nifty.
Yeah.
So there was, a lot of stuff floating around in terms of, data and everything. So, just went through and then saw that, look, it doesn't make sense for anybody to, in fact, buy any stock. If you want to be invested in the market, you basically buy the top market. And then, it's very interesting that, that time, even now people say that active management beats indexing. But when we just analyze some stuff, that if we looked at the risk ratios, we looked at Sharpe ratios and a lot of other ratios at that time, just, as more, academic than anything else. And we saw that India is exactly the same as any other market. Whatever people might say, that, basically at the end of the day, the foreigners were coming in, there was a lot of institutional money coming in. So we thought it makes sense to basically have a product for Indians which can give them an ability to index. So that was starting point. The other starting point was that basically, having worked in the industry, I saw that basically too many of people were really, the intermediary was taking too much, and the product provider was taking too much money off the table for the investors, whether they were right or wrong,
Yeah.
basically. And the distribution system, in our view, was little flawed. I mean, this is being an insider to some extent. 2-3% were really taken off the table. In fact, more 3-4% were taken off the table for the investor. I mean, think about it: 4% annualized for even for 10 years. It's huge.
Yeah.
It takes off a lot of money off you. So we said, can we come up with an idea that basically where you can do indexing, but we as manufacturer of products don't pay anybody. The intermediary, that is, the intermediary doesn't sell it, and then ETFs fit in very, very well. And then given that the India's footprint on ETFs, that's how the idea took shape much more aggressively.
Okay, and one of the reasons for doing the ETF versus the mutual fund way was to sort of bypass the distributors. Was that the
absolutely, yeah. So as I said, we had two philosophies. One was the investment philosophy, indexing. The second was the distribution philosophy. That basically we should not. There's too much of a conflict for the intermediary to who is the agent of? Is he the agent of the mutual fund, or he is the agent of the investor? And we said he should be the agent of the investor, and that's why we should pay. The investor should pay, and that's why not the mutual fund route, but the ETF route. And ETF route, to be honest with you, we thought India was really set up for it because at that point in time itself, there were nearly about 100,000 terminals of NSE. So now I think there are about 400,000, 500,000. But that time even then it was 100,000. So we thought this is the best product for them.
And you think even today the ETF route is better for index investors, or do you think with the way mutual funds are now direct and with all the changes that SEBI has brought around?
Yeah. So there are two things. Okay.
If you were to do it today.
No, as you said. So what has happened is that there are two things in terms of, again, the ETF structure. One of the biggest thing about ETF structure is basically you pay to the intermediary. Now that to an extent has been taken care of by SEBI. That you have direct, and if you look at the fees now, they have come down dramatically. So I don't have the exact numbers right now, but you can get a decent index fund for, I'm told, about 10-15 basis points. Or 20 basis points, whatever. That
is actually even lower in some cases. I think UTI is at some 7 or 8 basis points.
The index fund, that is?
Yeah.
So brilliant. So basically it's come down dramatically. So that thing is taken care of. The other thing is not taken care of, and ETF is a little better in structure, to be honest with you, in terms of mutual fund, is that basically ETF is always invested in terms of stocks. So the market movement is captured, except for 25-30 basis points where you have cash, most of it is captured. While in a mutual fund, given the nature of the beast, you would have about 3-4% which is not invested. So in terms of pure investment efficiency, our ETF is better. But I think given where we are, people don't have demat accounts, or people don't have the ability to go to a broker. What SEBI changes have happened in terms of direct, the cost of the fund and all that, a normal mutual fund also is not a bad idea.
Right. And sticking on to the ETF one, Sanjeev, how did you all manage the tracking error? Like, how did you manage to keep it so low? Whereas even today we see that, when we saw that in March again, there were so many ETFs which had a tracking error of like 4-5% on a few days, and there was a big doo-ha about that among people that if this is the kind of spread that is there in ETFs, then how am I going to how should I buy an ETF? So how did you guys manage it in those days?
So first, I think basically it was a focus. Our only business was ETFs. Okay, so we made sure that basically we understood how indexing is, what is indexing, how indexing works, when index changes happen, when do they happen, how do they happen. So we actually developed an algorithm, if you want to call it, or system or whatever, which we made sure that basically when the index changes happen, whether it's because of capital changes in a company or the stock moving in and out of index. We ensure that basically we tracked the price at which the stock is coming in and going out is very close to our portfolio. So that's again, that's not because of anything else. It's just that it was our bread and butter.
Okay.
If we couldn't do a proper tracking error, then why would anybody come to us? So that's the reason we actually made sure that that's something we were good at.
Okay. That's great. And moving on from there, then who was your, who did you have to educate? Because it was unheard of, right, in those times. Even today, we still have a very, 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 what do you call, active discussion about, active versus passive, and still a very passionate discussion on those lines. But in those days, I'm sure it was even more. So who did you really have to go out and educate? Because ultimately you wanted the retail investors to invest, but somebody had, for good or for bad, in investment products in our country are still a push product. They're not a pull product. So you had to get somebody to sort of go out there and push it to them. So who are really the people who you had to educate?
So we started off, and this is what we thought, were the right people, were the brokers on the National Stock Exchange. Or we were we listed on NSE, so NSE could have been BSE, but the broker, because we thought the broker is the end guy, basically will talk to the client, and he will basically tell him, it makes sense to buy ETFs eventually. And that's how we basically started off. In fact, when we launched the fund, we actually had only about 7 brokers, market makers, if you want to call it, who basically invested. So there was not retail issuance at all for ETF, the first Nifty ETF. The whole idea was that basically these people will buy, and then basically once the market it listed on the market, they will sell it onwards to the people, which is their own clients. So that's how we basically went ahead. We actually got our sales team to go to brokers and kind of evangelize them to say that basically please go to your clients and tell them about ETF because it makes immense sense. Now, to be brutally honest, they were the right audience, but you were wrong in terms of a timing, because at the end of the day, these people were basically wanting people to trade as much as they want. That was their bread and butter. They wanted people to trade. As much as a mutual fund agent wants to churn, the broker wants to trade. So obviously we were wrong in terms of our timing, because basically the minute you start trading, it becomes a problem. Because the whole idea of ETF is that basically you should be buying and keeping, so don't churn and all. Yeah, so we were a little ahead of our time, but we still think they are the right audience. The broker at the end of the day is the guy who basically should be going and telling its clients, look, this makes immenent sense for you. And one advantage we entered into the market by was that basically the futures were already trading 3-4 months before they launched the ETF. So they could arbitrage and give the two-way quotes and provide liquidity in the market. So to answer your question, brokers was the people we target.
So today, if somebody were to, let's say, build something on a mutual fund platform, you think the right people to educate would be the distributors and the advisors? Is that the audience one should target?
No. So yeah, okay. So one of the big reasons why the ETFs took off in US was that basically the individual advisors, the RIAs as they call it, registered individual advisors in India as they call it, were the guys who actually made the switch. They said that basically, look, I'm going to not take the money from the mutual fund. It still exists, 50% still exists, but I'll not take the money from the mutual fund, but I will charge the investor. So I'll take 1% off the investor every year. Now, when that happens, the investing advisor is always looking for the lowest cost product, because it makes sense, because how do I add value if basically I'm going to give out 200 and 250 basis points to the mutual fund manager, unless it's really outperforming or whatever, and it's damn tough to do. So we think that basically the RIAs and the brokers eventually are the guys who should be the ones who basically should be selling this, or the people who basically take the money off the investor in terms of their fees and not from the mutual fund. I think they are the right guys.
But we still have this issue of investors not wanting to pay, because when you have to cut a check to your RIA every year of 1%. So this is and one of the podcasts that Michael kites. So he mentioned this, that it still remains a problem that if people are willing to pay 2%, if it's sipped away out of your, it's called a reverse sip of sorts. If 2% is sipped out of your account, you don't notice it. But
agreed.
If you have to cut a check to your RIA every quarter or every year, it pains you a lot to sort of write that, and then you start asking questions about what value is he adding, and I can do it myself and all. How you see that mentality ever changing, or do you see that behavior rather? Is there a tipping point for that behavior ever going to come?
Okay, so there are two things in that. One is the tipping point will come if the regulator, the SEBI, says that okay, your ability to charge mutual funds cannot pay, period, and you have to take the money from the investor. Automatically, it will change overnight because it's a regulatory diktat. Nobody's going to do it for free, and people will understand that basically I have to pay my RIA, my advisor, to basically get this. So that's one way of doing it, and I think it's not a bad way of doing it, because at the end of the day, the mutual fund should not be the one who basically should be paying the intermediary, because there's a conflict of interest, inherent conflict of interest. So that's one way of looking at it. The other way of doing it is also that basically it's actually not very complex. It's basically instead of charging fees every day, the amount is calculated for the RIA on the client's account on a daily basis. How much is the way the mutual fund calculates its fees, then automatically the behavioral problem is taken care of. That basically you take the fees off from the client on a daily basis, and then basically you pay off the mutual fund itself pays off, or basically the money when it redeems or things like that. So that also is the another way of doing it. But my view, I would opt for a way that basically the regulator says the mutual fund cannot, or the product provider cannot pay any fee to the investor. The investor has to basically pay if they is taking help of intermediary directly. When that happens, then there is no second. There's the ability for the intermediary to take money from the client. He'll change his business model and make sure that this is the client pays. And that's, I think, will be a tipping point. And I for that as a model.
And I think we are getting there today, right? In terms of the recent changes that have happened in the RIA guidelines, the regulations. Correct. That they have said that there is a slight leeway there, that you can provide both execution as well as advisory services. If you, that every Chinese wall has lots of windows. So
correct. So I think if they close that, I think it will work. That's my personal view.
Yeah. I think I think I share that. If they start allowing, they stop remuneration of advisors from the mutual fund side, that could solve this issue a lot.
Absolutely.
Now, after you sold, Benchmark to Goldman Sachs, how have you seen the industry evolve from within Goldman Sachs, and even post exiting Goldman Sachs? How have you seen in the last 10? It's been 10 years, right? Since 2010, 11.
That's right. About 9 years now. So when we moved to Goldman, we had the opportunity to actually interact with the government and with the CPS ETF. Now, I don't have the exact numbers, but we could use the ETF structure to basically raise, in a sense, about 90,000 crores worth of divestment for the government. So we were very happy in terms of the fact that basically a new instrument could be used for divestment. But more importantly, within Goldman, what we could do was basically convince EPFO to invest in equity, number one, and number two, invest in an index, which is the ETF. We at Goldman didn't get the business for whatever reasons, because of the structure of Indian regulation that it goes to only the government entities, but it doesn't matter. What we are happy about is basically how it's evolved is basically now, I don't know the exact numbers, but 90,000 crores of investment is now by EPFO into ETFs.
Yes.
Now that's a large number. And just thinking of number, basically say, 2% is saved if you don't go to the active manager. You assume that they were going in equity and going to the active manager. 2% on 80,000 crores every year is a large amount. We're talking about 1,600 crores. So we are happy that we could actually save 1,600 crores for the investor, actually, the PF holder. So that gives us satisfaction. So that move by EPFO into ETF, I think has brought in some amount of importance to the ETF industry in terms of investment. But what saddens me to some extent is that basically, we have really gone and knocked off the fees completely. No, I'm not saying that you should have high fees, but you cannot be in a business where you're not making money. We know that, basically running an ETF takes you about 5 to 6 basis points cost of running an ETF. If you're really large size, it comes down by 2 and 3 basis points. So, given where the fees are, my worry is that basically, a standalone new player in ETFs will not be able to sustain itself. So that in the long run, will not bring in innovation, will not bring in new ideas in indexing. So that's the worry I have. So I'm very happy that no money is coming into ETFs and indexing, but very unhappy that basically the fees have gone down, not because of anything else, just that basically, we want independent, pure indexing companies.
So, in your view, the fee hypothesis, or the what Bogle called the cost matters hypothesis, is that still the base case for indexing? Is that still hold true? And besides that, besides the fee, what else would you say is the reason why people should index, or retail investors should index?
Oh, no. The fees is obviously one of them, and is a very important factor. But I think basically the most critical factor is basically that basically you are getting the market, and you are not dependent on the fund manager. And most of the fund managers underperform. Even if they don't underperform in a year or a couple of years, they don't do consistently. I mean, the whole there's a great example of Leg Mason, and their fund. I don't get his name. Bill
Miller.
Bill Miller. That basically
the Magellan fund.
19 years he outperformed. 19. And that's a long period of time. But in the 20th year, he actually underperformed the whole 20 years. So, you don't know when it's going to hit you. So I'm not saying that basically the active managers don't outperform in a year or 2 years. The problem arises in consistency. Now, I can give you an example in terms of, people say India is totally different and all that. We actually did a research from 2005 to 2010, and it's been published in the Journal of Indices. Which it's a journal. It's kind of an academic study for indexing. Okay. Where we had 2 papers. One was the myth of the persistent alpha and myth of consistent alpha. So we said basically it's very, very difficult for someone to outperform, and we took the Indian data. Okay, Indian data from 2005 till 10. If you Google Journal of Indices, it should be there. So, people kept saying India is different. India is not different. So I'm very happy. My point of view is very simple, that why should you invest, why should you index, is because you want market returns. You will get market returns 10 years, 20, 30 years from today without any volatility of how a fund manager behaves. That's it, period. Cost, obviously. I'm taking cost as a hygiene factor. Beyond cost, this is what it is.
Yeah, so, even last year in 2019, so I did this study which was published in ET Prime finally, that I took the inflows and the outflows. So it took care of the survivorship bias, because so many funds get merged and all of that. So I took all the equity inflows and outflows. I did a time-weighted return, and from 2010 to 2019, and it was astonishing that the amount in aggregate by which the actively managed funds underperformed the index was exactly the amount of the fee that they charged, which was 2%.
Exactly.
And that's what they found in the US 40 years ago. So I was astonished that that it turned out to be exactly that 2.5% number, that by which in aggregate they underperformed the market, which is what I mean. They are not able to overcome the drag of 2% to 2.5% that the fee puts upon.
I hope your research gets more publicity, because this is what needs to be told to people at the end of the day.
Yeah, and sometimes people ask me saying, you manage a PMS and you run an active fund and all of that. Why do you talk about indexing? I said, look, I talk about indexing is because that for 90% of the people, they need that in their portfolio. You can add 10-15% of my fund as your satellite portfolio, but I always tell people that as your core holding, you should have index funds, and there's no conflict of interest there. I mean, I'm not underselling myself. I'm just saying that for that the additional risks, I do a lot of factor-based investing. So So I tell them that, look, this will give you a chance to outperform,
Sure.
not necessarily that it's
Sure.
to outperform. So
again, so I don't want to demean. Okay, you're not doing active management, but I don't even want to demean active management. I'm not saying that they don't add value to the system, but do they add value to the to the cost, to the charge they are levying us? As simple as that.
Yeah.
To my mind, no. That's it.
So So your Bill Miller example was, he said in 2000, he said, if I'd retired a year earlier, I would be a genius.
Yeah.
But in the year in which I have retired, I'm a fool now. So
So the point is very simple. That basically, it's very difficult. You may be the best guy on earth, but it's very difficult to beat markets. So don't try and act smart with the market. That's all. Be mediocre sometimes. Yeah, it's okay. You get the
and
best
that's what Buffett said. No? Ironically, when dumb money recognizes its limits, it ceases to be dumb and it becomes smart.
Absolutely.
So that, and Sanjeev, given the landscape today, now we've seen some of the mutual funds are launching index funds because they know that there is no alpha left in large caps, and it is becoming very, very visible. It's no longer hidden even to distributors and advisors. So they're sort of self cannibalizing that space. But then on the other hand, there are a couple of other fund houses like Motilal and a couple of others who are going out there and launching an S&P 500 index fund, or they are trying to at least push into index funds as an alternative, or somebody like DSP, which has launched a quant fund based on factors, and Zerodha, which has applied for a mutual fund license, and they've said that we are going to be launching only passive products. So, what do you say to all of these? Who do you think will sort of emerge as I don't know if he'll ever have a vanguard kind of structure, because that structure where the investor himself is the shareholder, that inverted structure which Bogle had. I don't know whether we'll be able to have that in India, but maybe we'll have something, slightly inferior than that, but still something that works. So whether it will be Zerodha with its passive approach, but getting its income from broking, or Motilal with its, with its dual approach.
So, as I said, the biggest problem which I see right now in India in indexing is the fact that basically the fees are gone. So basically, unless somebody is subsidizing to some extent, you cannot survive. So in a sense, Motilal with his active management and Zerodha with his broking accounts will have to basically, kind of subsidize the whole business. Now, if you, as I said, if we were to set a benchmark today, standalone benchmark starting off today, the tough one will be because we won't get any income, especially in the larger size funds. So obviously we'll have to do something, kind of factor investing or factor models and things like that, and charge higher fees. But as a pure indexer, we won't be able to get it because standalone you can't survive. So to answer your question, I think people who basically have indexing as a part of your portfolio and make it a very important part of your portfolio, I think will survive. But as a standalone, unless the fees move up again a little bit, I don't see that happen. But I think it's okay. I mean, at the end of the day, the investor is getting a benefit out of it. So, if somebody is using indexing as a way of, getting more clients in terms of broking or getting clients who are active, fine. Good luck to them. But I think, those are the kinds of people who will survive. But what will happen also, I think, one doesn't know the future, but I think given the size of the Provident Fund, which is going to keep growing every year now, I think ETF is going to become mainstream in terms of, people will know ETFs, I think. What will happen is people will know what is ETF. One of the biggest thing 10 years back was ETF kya hota hai. Now I think that issue will be gone. So you'll see more and more money coming in. So and more people thinking about indexing. So people who provide structures on ETFs, let's put it this way. So a mutual fund may not be able to make money, but an advisor, we talked about. I think, who gives proper advice in terms of, how much you should be in asset class, another asset class, and use ETFs for doing that, I think will be the driver of growth for the ETF business. And that's where the money will be, as I see it. Be it online or offline, whatever.
How they manage the conflict ultimately is, the philosophy there. Because Motilal, obviously, I not Motilal, but some other fund houses I've spoken to, and they have a passive team now and an active team now. And the guys selling the passive products are the same guys they sourced from the active.
Oh yeah, that's a problem. Yeah.
So they are so disheartened, and they one is that they don't believe in indexing at all. They're just doing it because they've been told to sell an index product. But they are like, I don't, what case am I going to make for indexing to sell to my clients, and what am I going to make out of it? So how do you think, even if somebody was housing an index SBU within their active complex, how should you structure such a
totally different sales team? Totally different sales team.
And hiring also should be from a different.
Absolutely. Totally different. And the second thing I would say, we are totally different, the portfolio team. Because, basically you don't want the active guys basically, trying to time the market and all that, because then you will have the problem of tracking error. You just want, people who basically, are only purely indexing. Yeah. In fact, I would say, basically eventually the portfolio becomes, the machine does the portfolio management great. If it can be done. Right now we have regulations you can't do it, but it would be great. So I would say a totally different sales team. Sales in the sense, how you sell ETFs is totally different from how you sell active management in my view. I mean, just to give you an analogy, it's like, when you sell ETFs is more like the medical representative of a medicine, because, you don't know which doctor is going to buy. You have to keep evangelizing, basically, please buy. That's a completely different mindset from going and telling a distributor, hey, kitna kiya, I mean, have you done 1 lakh, 10 lakh, whatever. So I think completely different sales team, completely different way of selling. I think that will be the critical. And I think the guys who will be successful, to answer your previous question too, will be the guys who actually, do that within their own unit. So if you are a Motilal or a DSP or a Zerodar or whoever, or Reliance or whoever, if you can differentiate, keep those ideas separate and go out in the market separately, I think they will be the guys who will get the maximum assets in mind.
Yeah, because even today you see some heads of passive funds coming out and saying, oh no, we have a passive fund, but there is still alpha left in the active.
Yeah, so that's where basically it's going to be a killer. It never works. It never works.
You can't have two conflicting ideas, and
it's like riding two horses. It doesn't work. Yeah, you are going to fall.
Only Ajay Devgan can do it. Has his 2 legs on the sides and ride out of it. But it's not going to work for the
fund managers are not CEOs are not Ajay Devgan. So.
Yeah. So what do you think of factor funds in general? Do you think they could sort of be the bridge to moving from active to passive in over a period of time?
Yeah, so I believe first, basically you should be invested at least 50-70% in your core market cap products, because that's where the market is identifying that. And I think factor products are going to become the bridge, as you said, more importantly because the way the market is evolved, the kind of risk you want to take, because you've taken the market risk. Now you can slice and dice your risk in terms of, okay, I want to take this kind of risk. You can define your risk basically. It's growth risk or momentum risk or, value risk or sector risk. There, I think factors will play a very important part. And more importantly, I think given the way the fee structure is shaping up, I think the factor indexing will become an ability for you to even charge a little higher fee than what you're getting, because otherwise you can't. And that will be the sustenance for you with the other products. And more importantly, it will allow you to slice and dice the kind of risk you want to take. The factors you decide, which factor invest, which factors you want to play out in the system, and we can choose whichever you want. But I think that's the key forward in terms of, if I can put factor into the indexing space, I think that's the future.
So, what kind of people did you hire, Sanjeev? Because you also built Benchmark from scratch, and at that point in time, obviously, you were the first one. So the only place, if you wanted to hire experienced people, you would have had to look at the active space. Right. Or you would have had to, recruit somebody who's completely inexperienced, and then help him grow from the ground. So, what was your hiring and team building approach?
So first we hired somebody from the indexing company. which was ISL as it was called and then, and I think now it's called NSE indices, just to make sure that basically we understand the whole indexing process and the person can actually run the portfolios. Post that, we only hired people outside the industry, not because of anything else. Having been in the industry for 14 years, then we knew that basically they will come with their baggages, and we won't be able to break that two-pronged philosophy we had, which was one of the investment philosophy and the other was the distribution philosophy. As you said, that basically, if I still believe alpha is going to be there around and float around, and then I go to sell in the market thinking that basically, please buy my product, but by the way, alpha also works. We thought it never worked. So we actually got people from outside the industry, and we got people who basically were completely fresh, and we trained them. Now, is that the best way of doing it? Obviously not. It takes time and it's expensive in the long run. Because it takes time. It takes you 2-3 years for people to get the system and things like that. But I think it worked for us. I really think it worked for us because we didn't have any contamination in terms of basically does active work or not. There was it was kind of basically I would say religious, if you want to call it. So it became a much better way of actually handling it. So we didn't hire anybody from the industry at all. See, eventually, I think I would say 7-8 years down the line, we needed people who basically knew the system and all that. We did hire a couple of them, but my choice was that we won't hire anybody from the system, from the existing system. So that's what.
Any interesting stories when you guys went out and pitched this to brokers? How did they react? Like especially in the hinterlands or in the smaller cities?
Oh yeah, so I remember going to Ludhiana and talking about Nifty Bees. So basically a couple of things. Basically they say the honey wala product nahi chahiye humko. Some people say Bees is 20. There are only 20 stocks. So but I'll tell you when see the interesting part was basically the guys at the hinterland. To be honest with you, they're really the guys who basically are traders. They want their clients to trade. So they didn't like us. Let me be honest with you. However much we can give a very nice romantic story to it, but the reality was that basically kitna paisa bana sakte hai bhaiya wo bataiye pehle. Our idea was कि भैया तुम पैसे नहीं बनाओ, पूरा client को अच्छा लगेगा, client को जो होगा मेरा होगा. So that was the story. But I'll tell you one very interesting fact. When basically we actually announced a gold ETF. Because there was first time of its kind of nature in the world, and we wanted to do a lot of things on the gold ETF. So we gave it to SEBI and it was publicized in the papers.
Correct.
This is 2002. That's when basically whenever we used to go, people never wanted to talk about Nifty or the other ETFs. Are gold ka baar hai, because the broker never had the access for them to buy gold for their clients. So that was one of the top. So it became a nice way to at least get appointments. Let me put it this way. Because otherwise they won't talk to us. At least we could at least go and talk to these people and talk about ETFs. We know that basically it took a long time for them to get in, but at least we got an opportunity to talk to them thanks to gold ETF. So that was the interesting part.
Yeah, because gold is we love gold as Indians, right? So that's something that they would definitely. And you tried to launch a silver ETF also, but I think till date SEBI has not approved that.
No, so even gold, if to be honest with you, our idea of gold ETF was not to buy gold. Our idea of gold ETF was to buy gold paper, which is basically the banks lend to the jewelers. The jewelers take it because they don't want to borrow in rupees, they want to borrow in gold. And we thought this would reduce the imports in the country. We really had that thought in our mind. So basically people will earn actually because of the fact that you get interest on that papers. But you know what? And it's been documented in the Mumbai International Finance Committee report. It was very, very tough for us to basically break the Reserve Bank of India there. I can say it now. SEBI was keen. We went to the Ministry of Finance. The finance minister actually announced his budget. Then 4 years later, this is 4 years later, okay? Even after that, it took us 3 years. And RBI screwed the whole product by forcing us to buy gold in our view. So, and remember, here's my take on gold. Indians don't buy gold because of pure gold. Obviously, it's liquid, and we know that marriage is evil. But I also think Indians buy gold as a hedge against Indian currency, the rupee. I see gold as one way of basically instead of sending your money through LRS, everybody can't send money through LRS. Indians buy gold. That's how, and I've seen that until when we had the gold product.
So if yeah, go on. So
no, I was saying, basically, our idea was to make it very simple for people to buy, simple, at lowest possible cost. You go and buy gold today, pure gold. Now we have the gold bonds, but the pure gold, your cost of transaction, buying and selling would be nearly 7-8%. Our idea was to bring it down to kind of really, 30, 40, 50 basis points. But yeah, that was fun time.
So, Sanjeev, if you were to tell an average retail guy to, if he was just doing an asset allocation for, let's say, long-term wealth creation, how would you tell him to sort of allocate his investment between active, passive, gold, real estate? What would your take be on that?
So, okay. So, I mean, look, I'm not expert in asset allocation, but
yeah,
but my view would be, that, basically you should be passive invested most of the time. 60, 70%, whichever asset you buy. And let's talk about how you invest first and what to invest second. Assume that basically you're buying equity. You should be buying most of it is in passive assets, and the other in factor investing, where basically you understand the risk, what your risk you're taking, and then basically buy that. I believe that basically active doesn't work. Factor works not for anything else, because you don't have too much of judgment coming into it. You've taken a judgment in terms of what should you invest in. That's a call you've taken, fair enough. But then do factor investing in terms of however you look at the product and whether it works on. Same goes for debt. Ideally, basically, do passive more than anything else. Now, coming to what should be a portfolio, there's a standard formula saying that basically, depending on your age, you should buy that much equity. So if you're 30, then 70 should be equity out of 100, and so on and so forth. Now, in India, I think, basically gold should be bought not for anything else, because gold is a proxy for your foreign asset, if you want to call it.
Yeah.
And also it diversifies much better than any other asset. I mean, I'll just give you an example that I think in the last 1.5, 2 years, gold has gone up by, I think, about 60% as a price. And you assume that basically you had 10% in your portfolio, just 10%. That whole portfolio gave you 6% return thanks to gold.
Correct.
Right? So it diversifies your assets. Number two, basically gives you an international asset. So I think, basically my personal view, I'm a fan that, Indian markets, growing economy, forget what's happening right now, but, growing economy, you should be anywhere between 50 and 70% invested in equity. Unless you're 80 years old. Now, let's not go there. I'm just talking about someone.
Just average. Yeah.
Average. Yeah. The 20-30% in bonds, long-term bonds, because I don't see any good reason why you should be basically, going short-term, and rest for 10-15%, depending on, where you are in your either in gold, in my view, or in other assets like, you have NASDAQ and S&P 500 of US and things like that, because that gives you an international diversification.
So you think that one should have a little bit of international diversification?
Absolutely. I believe that, and I think Indians have been doing it. My view is Indians have been doing it through gold, but you do it much smarter way by buying the stuff you have now.
Okay. And we don't have really. I mean, we're getting there slowly, maybe, but we don't really have a passive bond index or a passive bond product in India.
Yeah.
Do we really?
Yeah.
Like with different maturities, where.
Correct.
So, now, in some way, okay, I wouldn't call it a passive product, but the one that we have, the Bharat bond ETFs, which are 3-year and 10-year, and then they're going to sort of have a whole series of, which I think is going to confuse a lot of people, because right now you have two ETFs. Then you're going to have the 2024 and 31. Then you're going to have 25 and 32. So then you're going to have like 6 floating around. But if you were to do a passive bond ETF or a passive bond index product, how would you construct one?
So we actually have given it to SEBI, to be honest with you. This is pre-Goldman. I don't know, year 2009-10. Our idea was that basically we invest in government securities. Because, government security becomes, you don't have to worry about which security you're buying. There is no limitations and things like that. Number one. Number two, basically, the liquidity of a when the maturity goes from on the run to off the run. Also, it's not off the run is bad, but not as bad as corporate securities. And you're not taking credit risk. And to our mind, it was better that basically somebody takes a passive investing approach in government securities where you don't have credit risk is better than taking credit risk. Not for anything else. I'm not against credit risk. It's just that basically our debt markets are not evolved yet. As simple as that.
Even after Franklin, you're not against credit risk?
No. I'm not against credit risk as such. But how we manage credit risk is a separate issue. I said we can have a separate discussion on that. But I think people should take credit risk. But whether we as mutual fund industry have been able to get through to how to manage credit risk is a separate conversation. Totally different conversation. So that's why I think basically we should have. I think we can't, and that's why we should have government securities. So our idea was that basically we would have government securities. And again, we actually had a problem in liquidity. Indian debt markets are very liquid, and it's a problem. And that obviously reflects in the ETF market. It would reflect. So we had actually got prime dealers, as they are called, for government securities to basically make markets on them. But SEBI in its wisdom did give us the approval and whatever. But if you see, your question was how would you construct it? I would construct a government securities index based on maturity. I would do 3, 5, and 10 right now. Then obviously, with the aging, you will see a full curve coming through. Some of them will not trigger it. Fair enough. We understand that. But I think that's the way to go to actually create a full bond ETF or government security ETF portfolio.
Yeah, because you see, even in the mutual fund space or in the PMS space, fixed income is a very, very large piece of which is not given as much media coverage or attention, because it's the amount of money that you make on that in terms of basis points is small, but the volume is
absolutely
very, very big. So somebody is able to get that space into the passive approach. I think that will be.
I think the best way to do it, and I still think it's the best way to basically do government securities. Very simple, liquid. You'll have market makers. You can actually force the market makers to basically provide markets at a cost, obviously. And I think that's the best way forward. And I think it will work. It's just that basically, actually, since we are talking about it, if the question was, if a new player comes in, what should be the way to go? I would think, if you want to really get it into passive space, fixed income or a government security ETF may be a good place to start. So, at least you start making money, and then, that could subsidize your equity also.
Yeah, and people are more comfortable with debt in some way. It worked a little. It backfired in the credit risks thing where
That's why I say
But overall, I would agree with you that if you are able to sort of get that product out first, that can be sort of your loss leader, and then you get people in to come in there. Yeah. So a couple of questions from our friend, and he wants your take on market efficiency, and it's being challenged all the time. And so what's your take on that? Are markets efficient, not efficient, weekly or semi-weekly efficient?
So we can. This is a debate for academicians, and you can debate it until the cows come home. The reality of the fact is that you can call markets efficient, not efficient. What do you define by efficient? That basically if you have extra information, can you outbid the market? That's the question you have in terms of efficiency. Now, my personal view is that basically efficiency is also what you might call is a moving concept. That at a point in time you may be efficient, but to remain efficient you have to keep running, and the efficiency has to keep happening. That means that information has to assimilate into the markets. Somebody at that point in time who's got that information will be obviously better off. But to my mind, markets are enough efficient for not one person to take advantage of that information. You can take information at a point in time, but that same person cannot be doing it consistently, even on a daily basis. That's my view. And that's why I find the markets efficient. I mean, again, this is not
Yeah, no,
etiquette or
I
whatever.
would sort of agree with that. That they are efficient enough not to let somebody be, have
Correct.
a run or being. I mean, like, so we have this farmer example, where he, I believe in his PhD class, he talks how he explains market efficiency. That there is a tank full of fish food, and then you put piranhas in it, and they gobble it up immediately,
Right.
without
Absolutely.
before the other fish come in, and
Yeah,
they gobble it
exactly.
up. But for the tank to remain clean, you need those piranhas. Otherwise,
Correct.
you're not going to have the tank clean.
Absolutely.
But the piranhas are not going to come if there is no food. So
Absolutely.
you need some amount of active to keep the market honest and efficient. But they also have to be compensated enough to be
Correct.
attracted to the market. So there is
Correct.
this joint hypothesis conundrum that you can't have one without the other.
Yeah, that is one. And second is basically the same piranha won't be able to eat all the time. That's my point.
Exactly. Yeah. Correct. So, Sanjeev, couple of other things that are there that as solutions which can come in India, but we don't see them. And one of them is something like target date funds, or something like which could be used as solutions, could be sold as solutions, but are not making headway into India. So is it because the investor base is not growing? We are still at that 2 crore, 3 crore kind of investor base. It's just about 2% of the market that invests. Or is it that we are still very new and nascent as a capital market? Uh,
So my view on target funds is basically, see, if you with what we talked on the debt side, on the fixed income government security side, I was talking about actually target funds that basically
yeah,
you have a
yeah,
3, 5, 10 years, and then it slowly winds down. Why it's not happening is two reasons. One is basically, I think, basically the active managers, even in debt, we've seen the fallouts, but still, because debt funds are really still sold, I think, rather than bought. ETFs, the indexing has really worked in equity, but not debt yet. I think basically because they go and sell, they have to sell some expertise, and that's why basically target funds don't make sense for them. Even though I think for the investor, target funds make imminent sense.
okay,
So I think anybody, again, I think it's time. Anybody who comes up with the idea that basically, okay, government securities, this is the maturity, 3, 5, 10, 15, 20, whatever, please buy. I think it will work. I think they will sell. I disagree to a point that basically target funds don't work, but if you look at the tax-free bonds, let's put it this way, when they come out, it's 10 years maturity or whatever, 5 years
yes,
or 10 years,
yes,
they get gobbled up. They literally get gobbled up. Now, people are taking risk on only one asset, but I think because they are government-owned entities, people think that basically the risk is less, and that's why they basically buy. So I think if you look at basically target funds are not working, it's not true that actually you have a huge market. So one is the government, the tax-free market, and the second, and very interestingly, is the FMP market. What is the FMP market? FMP market is basically fixed maturity plan, right?
correct.
It's target maturity, in my view. So that works. That the amount of money which is has gone into it. Forget the credit risk part. Now let's keep that aside.
Yes,
This.
yes.
But as a philosophy, people want to buy that. I want to invest for 3 years. I want to invest for 5 years. I want to invest for 10 years. So that there's a huge investor base in my view. It's just that you got to get it right in terms of the product. And I think the products. Anybody who's really wanting to get into the indexing business, this is a great space to start in my view.
Sanjeev, a point we spoke about earlier, which was how much time do you have, so that
No, I'm fine. Don't worry. Don't worry.
Okay.
I just.
So, a point we spoke about earlier that which was about performance fee or fees for mutual fund managers. But one of the things they say that we would love to charge maybe a performance fee, but it's just too complicated and that model will not work or something like that sort. Do you think there is a hybrid model possible in the mutual fund space where they take, let's say, a 50-100 basis points for say as fixed fee, and then charge a performance fee over and above that, or some other kind of model that would make it little bit more fair or favorable for the investor?
Oh no, I've been a votary of that. In fact, I wrote an article a few years back on this. That basically today in ETFs you charge whatever I had written 25 basis points because I think that's a fair number. 25 basis points you take because that's your cost of basically managing the fund and then research and whatever. That's your basic cost, and you should get that money, right? Excel active manager. Now rest, because what are you going and telling the investor in the end? Basically, look, give me money because I can outbid the market. That's your call. That's why people should give you money, right? Why should you take fees if you don't outperform? I think it's not fair because as a human being, as a fair person, you would say that I asked you money, I have outperformed, I should be able to give. Now, I think one of the big arguments they come and say, if you give me money and I'm not outperformed, it's very difficult to manage. It's not difficult to manage at all. And let me give you an example as to how to manage. Now, basically, assume that basically you take 25 basis points every day. And in 25 basis points, you should get, not for anything else, because that's your basic cost of running.
Yeah.
Now, you say that basically, say we have 225 basis is the total cap in your cost. So there are 2 extra 2% which you get. It's very simple. You are not doing an ETF. You're doing through operations, basically like a mutual fund unit. The units are basically electronic. You don't have a problem. Say, assume you invest today on day 1 as an investor, and you take the money out on day 100. Assume that on that day, you calculated how much is the return of the market. Assume that basically you outbeaten the market based on the index you have talked about. Say your outperformance 10%. Then you get the fees as defined, how much fees you're going to get. Because each transaction on operations is individual to the investor in terms of the operations, in terms of the registrars and people who keep the books. It's not difficult at all. You take 25 basis point until then on that particular day. On that day when you redeem, you get that much. Now assume that basically you as an investor have only kept it for 100 days and the market was bad, so you don't, obviously fees are not, and the market takes off the other day. Fair enough. You lost out in terms of your market performance, but then the fund manager will get money from the other existing investors. So in terms of operations is not a problem at all. In my view, this will help in terms of operations. It incentivizes the investor to the fund manager to make sure that basically outperform. It tries to outperform. I don't believe it you can, but at least he makes an effort. Number 2 is basically that the incentive structure actually changes the way the distributor also functions. Because what happens then is, if I'm a distributor, then I will only go to people. I'm also going to earn money if the fund is outperformed. Otherwise, I don't get fees. On 25 basis points, I'm not going to get anything. So I will also only suggest funds which basically outperform, or I will take you to index. Correct. This is my behavioral change. Because I'm only going to go to places where I can earn. So if indexing is making me money, I'll go there. Or if I think that you are so smart and I believe in you, I think you're going to outperform, then I'll go to you. But if you're not in the middle, I'm not sure I will not give you the money. So that changes the way the investor also, the intermediary also functions. So I think, I think in my view, I think that's how, we should be moving forward in terms of fee charging for mutual funds. I think it's fair to everybody. It's fair to the investor, it's fair to the intermediary, and it's fair to the product provider.
Yeah, I mean, what you say makes immenent sense. But there's this whole debate going around nepotism around in the whole show business. But we know that it's there in every business. That there are some certain. I mean, the 80-20 principle works. There are powerful people and powerful interests which sort of control the.
But that also this takes care of that. See, if you don't perform.
But will they allow these changes to happen?
No, that's the question. That's a $1 million question. And obviously they won't, because now they're listed on the exchanges. They have to make money. Yes. Obviously, it's going to be tough. But I think, basically, if we keep harping, things change. It's not so bad. But got to keep
slow, but but it happens. I wouldn't have imagined that the largest mutual fund in India would be an index fund, which SBI is.
Correct.
So we never know what happens.
What keep at it.
What events like they say that no equity strategist at the beginning of 2020 said that a bat-eating virus is going to impact the whole world.
Exactly.
Who said it? So,
exactly.
Who saw this coming? Sanjeev, as besides your venture as Benchmark and your stint with Goldman, what not a lot of many people know is that you were also a member of the indexes committee with Tennessee. And a lot of people, there are a number of managers or with some reason say that the index construction, especially in the mid cap space or in the small cap space, even the large cap space for that matter, they talk about it, but more in the mid and small cap, there are some flaws in that it's not constructed properly, which is why indexing will not work in India and things for that. Of course, the numbers are there for everybody. The SPIWA reports come out, and now we have SPIWA data for 15 years. It shows that even over 10 and 15 years,
Correct.
60 to 70% of large cap funds have not outperformed the index. So, that argument that way in terms of numbers does not play out. But do you think there is something we can improve in the index construction, or that there is too much turnover in the index, especially in the mid and small cap index?
So I don't think there's too much of a turnover. I haven't seen, because when we were managing the fund also, we didn't see much of a turnover. The cost of transaction is not very high, to be honest with you, in terms of index changes. Now, so when we started off, we were always pure market cap. So there was basically a filter of market cap, that basically the largest company, if you look at Nifty, and then you had this filter of basically liquidity, that you even if you were a large company, Wipro was a good example then. Now not anymore, but that time basically Wipro was not in the index in early 2000s, because of the fact that the trading was not happening. So if you put money on that, it would become difficult. So I think the filter was very clear that market cap and then liquidity. It was very clear. There was no confusion on that. But then they introduced a third layer, which I am personally not I don't believe it should be there, but that's a world moving to, was the free float index, where basically how much is in the, you put the weightages of that particular stock based, and one more filter is basically how much is available in the market, which is for FIIs and things like that, because it's easy for FIIs. But I think that was a wrong way of doing it. Now, what has happened, to be honest with you, is in the large cap, which is Nifty and BSE. I think basically most of them are basically that filter actually is of no consequence, except maybe a couple of stocks like Wipro, because most of them are basically very high in terms of free float. Yeah, liquid and free float also. So I think that so if you ask me an honest question in terms of the large cap, I see they're properly constructed. They really reflect the market, what the market is seeing as a good value for a company. And I am also not a votary of basically limiting any stock, unless it's more than 25-30%, and then become only one stock company, one stock index. Like Reliance now, I think is about 15%. I think it's okay, because the market is basically saying that in India, Reliance is really a very, very important company. Right or wrong is a separate issue, but that's how the index is. If it goes with 30%, maybe yes, we should think about it. But I don't think we should cap either the sector or a company. One of the complaints which keeps coming most of the time is that basically the finance sector is so high, the Nifty is skewed towards finance sector.
Yes, that was going to be my next question.
So my view, that basically, look, it doesn't matter, because at the end of the day, Indian market is valuing the finance sector way highly than the other sectors. Right, wrong is a separate issue, but they are valuing it much more than any other sector. Then why should the index not reflect that? So I'm a believer that basically let the market decide in terms of what you believe is a sector which should be getting more weightage in the top stock. My only view is that basically we should have only a 50 stock index. I think it's too limited. Unfortunately, in India, you don't have liquidity beyond 100 stocks in it. But I think like you have in the US, is 500 stocks. S&P for it's 500. I think at least 100. The Nifty or a Sensex should be at least 100 stocks. Not for anything else. Again, diversification. You're taking off a bit of the overweighted straight by adding more stock to the index itself. But the issue which comes up is basically, if you look at even the Nifty Junior, now it's called Nifty Next or whatever it's called, 50 to 100 stocks. The minute you go to the 9900 stock, the liquidity just drops off. That's the problem in India. Yes. We'll live with that. I think the market will evolve.
And that's one of the reasons that people, the active fund managers say that, beyond the top 100, there is alpha that we can sort of capture for you.
But they don't capture it. That's the best part is that. I mean, look at the Junior Nifty. If you compare to any other fund,
yes,
over the 10-20 year period, is one of the best indexes, which
exactly.
is performance. No,
It's,
the
it's
problem
just
is
as volatile, but it is
sure.
definitely
Yeah.
and so I
No,
sometimes
sharp ratio.
you use it as a proxy for your mid cap or something.
Absolutely.
If there's no
Yeah,
liquidity
absolutely.
in that,
Yeah.
just use that.
Yeah.
And you know, and some and there's also this canary that people talk about that, oh, the index does not reflect the economy. We are still a services, 50% services, 20% agri, 30% manufacturing, and the stock market should reflect the economy, but the index does not reflect that. So how do you answer that question?
No, that's simple. Basically, you have to look at what the companies are listed, right? See, until now, if you don't have listings, so let's take example. That basically, if for whatever reason, India's only defense sector is going to be the most critical factor in companies in the next 20 years, and the government doesn't list any of that. I'm just giving an example. I'm an extreme example, but let's take that example. That our growth in the next 20 years comes from defense sector. I'm just giving an example, right? And that becomes 20% of the economy. But no company is listed. So that will never be reflected. You only can take what is listed, right? If it's not listed, agriculture companies. I mean, even though 40% of India's population or 40-50% of the population actually works on agriculture, the total percentage of GDP of agriculture is only 15%.
Yes.
So does that mean that it's reflecting India? I mean, if you slice and dice in that sense, it's not reflecting India. Because 40-50% of your population is doing 15% of work. The GDP should be reflected at 50%. But that's not how it works. You have to look at what is available to you in terms of listing, and then are the listed companies fairly representing the economy as it should be? I think it does.
Okay. And what about this whole polarization thing? My take is that it's a feature, not a bug. That you will have these periods where maybe 5-10 companies will be a bulk of the index, but we keep having even the US now. They keep having this. They keep doing that pie chart and showing that okay,
Correct.
The top 10 companies, the FANGs plus Microsoft are. They are equal to the bottom 300 market cap, and now it goes up every quarter. It goes up to like 300 to 350 to 400 now. So, and in India also we have that same thing. The HDFC Twins plus Reliance.
The Rithik stock, as they call it, yeah.
The Rithik stocks, yeah. So they are basically the index, and that the other 40 don't matter.
But the problem, which and I agree with you. The problem is you don't know as of today. They are the 10 stocks which matter, but you don't know whether those 10s are going to matter tomorrow.
Yeah.
There will be some stock in your mind. So that's why first of all you should have an index which is 100 stocks, which makes it easier. And secondly, in that index you will always have 4 or 5 stocks which outperform the market completely at any point in time. That's the point of the index. If there's one, it's the argument then that basically you should have an index only of 10 companies. Right.
Yes.
That's if you deconstruct the argument, then it becomes that basically let's have an index only of 10 companies, which is but that's not how it works. You look at the market, what the market is doing, and the market is saying, okay, these 10 companies are very valuable to me today. Tomorrow they may not be. So it's the nature of the market. It's the nature of the beast, and I think we should be living with it and happy with it.
Yeah. Do you a little slightly provocative question, but I mean, people talk about it all the time, but nobody writes about it actively. Do you think a large part of our so-called active fund management industry are actually closet indexes?
If you look at the data, it is. If you look at the data, because if you look at the data, they only look at the top 50 stocks. See, look at. I mean, we have done it because we also had a S&P 500 Indian stock fund. The real growth most of the time came from the top 100, especially from the 51 to 100. So if the fund manager and they were so smart, they could have actually looked at only invested in companies which were basically the next 10-15 growth companies in the world, and they would have outperformed consistently over the years.
Yeah.
But I think the amount of money must come into mutual funds. I think they invest in the top 10 or top 50 stocks. So when you do it, that by definition you become a closet index. By definition, because if you're going to invest in a universe of 50 stocks, plus minus 1 or 2, some, as we talked about, some will go up, some will go down over a period of next 10 years. You will be a closet index. I think that's how the business is.
And that's because of career risk. You think that because they are constantly compared to the benchmark, and so you can't be further away from the benchmark. Because if you are an active guy, if you have active share in your fund, then you are going to be, if you are going to be different from the index, you are going to have a high tracking error.
Absolutely.
You cannot escape that, either on the upside or the downside.
Correct.
But the way that the media covers it, or the way that distributors look at it, or the way even investors look at it, that अरे market ऊपर गया लेकिन आपका fund नहीं गया, so
correct.
So somewhere I feel sorry for them also, that on a daily basis the NAV pressure.
Yeah, so that's one. Yeah, that I agree. So one of the biggest problems I see is basically the way we have constructed the industry is such is basically look at basically everyday returns. Mutual funds are not supposed to be looked at as everyday returns. I mean, they are supposed to be basically okay. I'm not saying they basically only look after 5 years, but there's no point looking at every day. Do it 3 months, 6 months, quarterly, yeah. But that's the way because I tell you why we do that. Because you want to churn. If the intermediary wants to churn, so what do? This is the only model which works. You tell him, बस अरे भैया देखो यार 10 दिन में इसने कुछ नहीं किया, 1 महीने में कुछ नहीं किया, अरे आप दूसरा फंड में ले लेंगे. Not the investor doesn't know what's going on because he thinks the money is coming, but actually the money is going out of his pocket by the intermediary.
Correct.
So yeah, that's why indexing works. Index में डाला खत्म, story over, तुम कुछ भी नहीं कर सकते उसको.
But that's the other way it doesn't work. What story do I tell?
That's a problem.
What narrative do I give to my investor that
Absolutely.
आप काम क्या कर रहे हो? आपने तो इंडेक्स ले लिया, अब क्या करें? अब बैठो.
Agreed.
That's
why
they don't want to sit.
Yeah. And people think that basically being active in markets is actually good, not realizing that actually they're just paying somebody else.
Yeah, it's a painful one. But so you think that if you were to bet your money on who would emerge as one of the largest, or who would sort of grow in the next 4-5 years in the passive space, would it be an incumbent or would it be a disruptor?
Well, I would bet on a disruptor, not for anything else, because an incumbent has no incentive to basically go beyond a certain point because of the fact that the incumbents today are basically wedded to active more than passive anyway. So a disruptor, but as I said, disruptor has a problem in terms of where do you earn. So I think basically a disruptor who basically breaks the fixed income market to start with, and then moves into the factor markets, not because factor markets are great or anything, just basically keeps sustenance. I think will be the one who basically will be the guy who basically in the passive space will survive. And I think, who knows?
And market weight or equal weight?
Oh, I'm a pure fan of market. I'm not a fan of equal weight. Not equal weight. No. Equal weight is basically you again making a choice, right? That basically the 50th company also is as market is not here. I believe the market has already made a call that basically these are the companies which make sense. Why should I basically act smart and say basically no, the 50th company is better? But that's my view.
And if you had to choose between a factor fund or an active fund, which one would you choose?
Oh, factor without exception. Active is out. I don't believe in active funds, so I will never choose one.
Okay, great. And Sanjiv, tell me, do you miss markets? Do you miss? I know you look at it from, you are very much keeping an eye on everything, but do you miss being in the?
Not really.
Would you come back?
Would you come back to the markets? I mean, why not? I mean, right now, one of the big reasons we decided to go into a different space, like payments and things like that, to basically get your. Sometimes, being in the thick of things, basically you lose a lot of perspective.
Yes.
This gives you a different perspective, and I am a believer that basically, if I get a new idea which makes sense, and then why not go for it?
Is there something you're working on?
No, not right.
Not really.
Not right now. Let's put it this way.
Okay. Great, Sanjiv. Thanks a lot, Sanjiv. This has been a fascinating interview for me, at least, and long overdue. And we're going to keep having you back on as much as you can.
No, great. Thanks for having me, and it was great chatting here.